It's too big. They definitely need to for sure, but it's a big pool, so you expect it. But it's very
Recently dropped. All right, let us go ahead and get started. It's 12:32, so. All right.
Trust me.
So, sent you obviously this model toward the beginning of the week, and then I sent you some underwriting models toward the end of the week, and we'll talk about those later. But what we're going to focus on obviously is the cash flow model here. And what I am actually doing this semester is I'm going to go ahead and combine the before tax and after tax all in one lecture today, and then we're going to add a new model for not next week, but the following week before and it'll be more of a what I'm looking for, cash distribution model. So we'll deal with that later. Okay, so this model obviously is already done. So the idea for today is to go through and explain it, kind of line by line, and sort of make sure that you sort of understand where everything's coming from. There's nothing in terms of the formulas for this. It's pretty much all adding, subtracting, multiplying, and dividing, and then with a couple of like calculate the payment or calculate the internal rate of return or net present value, which we've done all that before. So that's why I didn't really bother to try to force you to kind of work with me on the actual formulas. You should already be exposed to those up to this point. So in this model, going back to the whole thing of the yellow cells are the input cells, and then obviously the remaining cells are pretty much the output cells. All right, so with this we start off, now the idea kind of behind this model, and this is one that I just built, is that it allows for a fair amount of flexibility in putting in, virtually any sort of property type and whatever the assumptions are, and then goes through, obviously, and does all not only the before tax calculations, but the after tax calculations. And so you're going to get exposed to, if nothing else, kind of a precursor to what you're going to see in the real estate investments course next semester on the after tax stuff. So with that, let's just go ahead and kind of jump on in. All right. So the first thing, obviously, all the assumptions up here, I don't think we're going to explain too much out of this, but in terms of the rentable square feet for the property, 100,000 square feet, much like we were talking about this morning, what's the rent per square foot per year? In this case, $23. But then attached to that, we have over here on the right-hand side an annual rent growth rate of 3%. Okay, and we'll talk about how that gets worked in mathematically down below. All right. Then we have the vacancy rate, vacancy and collection losses, in this case of 7%. Other income for the property per year of $15,000, and then total annual operating expenses based on effective gross income of, in this case, 5%, which is obviously pretty low. But we have a growth rate attached to annual operating expenses of 4% per year. Okay. Everybody good so far? Nothing new here. This is all kind of just review. Then we have a required debt service coverage ratio from our lender of 1.3, which is obviously how we're going to be able to back into some of our numbers here with regard to calculating our NOI and our debt service and that sort of thing. Okay, so let's just sort of start with this first one. It's an actual calculation. Calculated NOI. All right, in this case, it's actually just pulling up from the spreadsheet down below, so we'll take a look at that here a little bit later. I want to try to kind of focus on some of the formula ones. All right, here we've got our maximum annual debt service based on the debt service coverage ratio. So this one, my assumption would be that all we're doing here is we're taking our net operating income number that we've got divided by our required debt service of the 1.3, and that's going to give us the 1.54 million. Okay?
divided by which one?
Two right above it.
Okay.
Okay? Then the minimum monthly debt service is just going to be dividing, obviously, the total annual debt service by 12. Okay? And the only reason we're doing that is because if we're going to work in monthly numbers, we need to go ahead and convert it over into a monthly amount. Okay? All right. So Next couple of inputs, we've simply got our interest rate for the loan, and then the amortization period for the loan. And then based on all of that, we're able to then calculate, well, what is that actual loan amount using the present value formula. So all we're really doing here, just using that information that's right above, we're simply saying, okay, we've got the interest rate of the 4.5%, which is B12. We're dividing that by 12 to get a monthly rate. Then we're taking, in this case, the number of periods, up here the number of years, 25 years, yep, times 12, which would be what, 25 times 12, 300, yep. And then lastly, the payment amount, which is the monthly debt service, and then this all for the loan amount. Yeah. So that gives us our loan amount. Then we're going to back into the value of the property based on the maximum loan to value ratio. So if we have a maximum loan to value ratio of 75%, to get the value of the property, we're simply going to take the loan amount divided by 75%, and that's going to give us 31 million. Okay? Now then, from that, if you're following the logic, okay, once again, all we're doing there is just B14 divided by B15 to give us the value of the property. Then what we're solving for right after that is the amount of equity we're going to put in, which is going to be nothing more than taking the value of the property, subtracting out the loan amount to tell us how much equity we need to put in, which would be the 7.8 million. Okay? Okay, pretty straightforward. Now then, ignore this stuff over here for the time being, because that's going to be important to us when we start dealing with our tax calculations. So we'll deal with that here in a minute. Okay, so let's move on down the page here. All right, so this is no different than what we were even doing this morning, you know, in the sense of you're putting together our operating statement, so potential gross income minus vacancy and collection losses plus other income equals effective gross income, subtract out those operating expenses, get our net operating income, then we would subtract out our annual debt service to give us our before tax cash flow. Okay, none of this from lines 20 to 27 is new. Okay, we have already done examples of that, obviously, in the real estate finance course. So everybody should be good to go with all of that. Is there anybody that's not good to go with all of that? Okay, now to get the future years of each of those line items, if we go back up here, let's just sort of take year 2 for potential gross income. All right, what you're going to see is you're going to take the first year and then you're going to multiply it by 1 plus the growth rate, which I think that growth rate was what? 3%? Okay, you look at it on your handout there. Yeah, 3%. Okay, and then you would do that for each successive year. All right. So obviously the next year is just simply the previous year times 1 plus the growth rate and so forth, so on. Okay. Any questions on that? All right. Now, the rest of these, for the most part, are just going to be, once again, kind of adding, subtracting, multiplying, and dividing. In the case of our other income, we're not changing it at all throughout this. It's just staying constant. You could go into hard code, you know, some changes if you needed to, but in this particular case, we don't have any. Okay, so we come on down to operating expenses here. Once again, you're going to be taking the previous year's operating expenses, multiplying it by 1 plus the growth rate all the way across. All right. All right. And our annual debt service remains constant all the way across. So once again, that should get us through all the way down to before tax cash flow. Then, what you shouldn't take note of is that there is a year 6. And if you remember, I believe from last week, we talked a little bit about this as well, that you use typically your year 6 net operating income as your sort of forecasted income whenever applying your cap rate for the resale of the property. And so that's all we've done there is to calculate in this case, what is going to be that dollar amount for the net operating income projected for, in this case, year 6. Okay, so as I said, up to this point, nothing is new, okay? All of that is just repeat, rehash over stuff we have done before, okay? Any questions before we now move into the new stuff? Okay, everybody good? Okay. All right. Now is when your head begins to explode. Okay. So, what we are going to be doing now, from lines 29 down to 34, is to deal with some of the issues that are going to impact our income tax that we're going to have to pay on the property. Okay? And so we're going to kind of go through and sort of explain what some of those issues are, and obviously take some questions, because I know you're going to have a few. This is normally, this would be covered in the investments course, so those of you that haven't taken that, obviously, you're going to see it again in the investments course. So it's a nice little precursor to that course. All right, so let's just start off with talking about depreciation and what that is and how it's calculated. All right, so one of the things that you have to sort of do is when you start dealing with income tax, specifically we're talking about federal income tax, is you have to understand it is purely based on regulation, okay? Regulation does not necessarily represent reality, okay? Now, let me make sure that I'm very clear with that. There is a tax world and then there is a real world, okay? And they are not the same. Okay, so the way things get treated in the tax world don't necessarily make 100% logical sense, okay? You have to sort of abandon logic and just look at what does the tax law say we have to do and how do we treat something, okay? Does that make sense? That's the precursor to all of this. All right, so the first thing that we have to sort of take a look at from a tax perspective is depreciation. Okay, in the tax world, there is an assumption that is made that a property is going to reduce in value from one year to the next an equal amount, okay? And the part that is going to decrease in value is the improvements value of the property, whereas the land value does not depreciate. So you have two components of value in any sort of real estate transaction. You've got the land value and you've got the improvements value. The land value, land for tax purposes, and pretty much reality is not depreciable. Whereas the improvements value or the building value is depreciable. And so what you have to do is to separate those two values and determine what that improvements value is and what that land value is, and then apply these depreciation rules to the actual improvements or the building value. All right? Now, let's just sort of, we're not going to use this as an example, we're just going to pull one out of the air to sort of give you hopefully straightforward illustration. So let's just say that we have a property and $8 million is the improvements value, and $2 million is the land value. So the total value of the property is $10 million. All right. So, based on what I just said, what dollar amount is depreciable? 8 million. Okay? So the 8 million, or the value of the improvements, is what is depreciable for income tax purposes. Okay. Now we have two primary depreciation terms for commercial and residential real estate. Okay? If a property is residential in nature, you have a 27.5-year depreciation term, okay? If the property is non-residential or commercial, it has a 39-year depreciation term. Now, the first question that you should ask is, where are those numbers coming from? The tax code, okay? These are simply regulatory standards that have been in place now, these specific ones, since about 1993, okay? And haven't changed since then. Now, prior to that, there were different terms for residential, different terms for commercial. The point is that, or the assumption here, is that residential properties don't last as long as commercial properties. That they're not, this is the tax world, okay?
They're built from different materials.
They're built from different materials, but the idea is that the residential properties are only going to last roughly for 27.5 years, but the commercial properties, because they're built supposedly with higher standards and building materials, they're going to last a lot longer, so almost 40 years. Okay, now, that having been said, once again, you're going to have regional differences, okay? Florida is a complete anomaly whenever it relates to this, because a lot of residential buildings are built pretty much almost to the same standard as commercial. You know, whereas you take, you know, a location like Texas where everything is pretty much stick built, or, you know, it's all just wood, you know, frame construction for residential, yeah, the property's probably not going to last that long by comparison to, you know, here where you're using concrete masonry units. But there are no regional variations given from the IRS tax code. So the assumption is just simply put, if it's residential, you get a 27.5-year depreciation term. If it's commercial, you get 39 years. Now, there are a couple of other wacky little exceptions that deal with like gas stations, and a couple of other where it's maybe slightly different, but 99.9% of all uses are going to fall into these two categories. Now, when we're talking about residential, we are not talking about owner-occupied residential. We are talking about residential properties held for investment purposes. So your personal residence, you don't need to write off like this, okay? It's only residential property that you are purchasing for investment. So now, if you were to buy a whole slew, or you know, even one, let's say, residential home that you rent out to someone, yes, you would be able to apply the 27.5 years. Now, the question usually comes up, what about mixed use? You know, and how do you deal with mixed use? Basically, if the building is 80% or more residential, you get to claim the whole building as residential, and that's a benefit because you get a shorter time to write off the property than you do with the commercial property. So there's actually a tax advantage to having a property that, let's say, is 4 floors residential with the bottom 5th floor as commercial, okay? All right, question?
That was my question.
See, wait long enough, I usually answer. Okay, all right, so we've got the two different depreciation terms. Now let's take a look at how we would sort of apply this. All right, so we take that 8 million, and for residential, we're going to divide it by the 27.5, all right? So let's start with that. That means each year we will be able to depreciate $190,909.09. Okay, that's residential. If it were commercial, you would simply take the 8 million divided by 39 years, meaning you would be able to only write off $205,128.21 per year. Okay? Now, what does it actually mean writing it off? Okay? What this means is that each year you're going to have a line item depreciation expense on your income statement, much like we have here on the screen. Now, obviously, we're not using the numbers from the property here, but this number here, this line item, line 30, annual depreciation, that number that is there basically is equivalent to what's here on the screen. Okay, does that make sense? Okay, not the same numbers because we're not the same problem. Okay, now before you ask the question, why is the first year different? We're going to get to that. Okay, all right, that depends on when the property was placed into service. Okay, now, but every year thereafter is going to be pretty much a fixed amount. Okay, now what do we mean by when it was placed into service? Well, the IRS allows you to prorate the depreciation depending on what month the property was placed into service over the course of the year. So if the property was placed into service in January, you get what is referred to as a mid-month convention, which is regardless of when the property was placed into service in January, the assumption in the tax world is it was placed into service January 15th. Okay? So even if it was placed into service January 30th, January 1st, January 20th, January, anything, for tax purposes, it's a half a month that you get for depreciation. And you're saying, why? Well, because the IRS is basically saying, we're going to prorate and we're going to do this depreciation, but we're going to do it on a monthly basis. But instead of getting into the nitty-gritty details of how many days in each month and prorating it day by day, they're just simply saying we're going to use a mid-month convention. So regardless of whenever you bought it and you place it into service, we automatically assume it's the 15th of the month or halfway through the month. So you get a half a month of depreciation, period. Okay? So it would be to your advantage, and it's not going to be that much, but it's going to be a little bit, to technically buy everything and put it into service at the end of the month, so you technically get 15 days of, of extra depreciation for that year, But hopefully you're sort of saying, well, wait a second. I remember in maybe taking an accounting class or whatever, and depreciation was done on an annual basis, not on a monthly basis. And that is true if it is other sort of equipment and dealing with vehicles or dealing with furniture or dealing with other sort of equipment. Those lower dollar volume or dollar value items, you get what is called a mid-year convention. So regardless of when you place it into service, the IRS assumes you place it into service halfway through the year, or basically June 30th. Does that make sense? Now, and the reason they do that is, once again, kind of for simplicity, but for real estate, they're saying there's such a big dollar amount, we are going to simply do it on a monthly basis. Okay? But it's also kind of interesting with the mid-year convention for other items other than real estate, that you will see people where that tax law or policy drives their behavior. Okay? That you will have people that will purposely wait until the end of the year, their fiscal year, to make a whole bunch of purchases of equipment so they can claim that they put it into service 6 months before that and get the tax benefit for it. Okay? And you're going to see all kinds of other wacky stuff with real estate as well, especially when it comes to expenses and capital expenditures, which we'll deal with a little bit later. But right now, let's just kind of go back to this. So our annual depreciation amount, once again, if it was residential, is based on 27.5 years, and then for commercial, 39 years, and obviously the two respective dollar amounts for this particular property that we're looking at here. Okay? Any questions at this point? Yep.
So if a piece of property, say residential, depreciates by $290,000, isn't the next year based off of that amount minus the $290,000?
Yes.
But you said it's $290 per year.
It is. In other words, the value is going down.
Yes.
In other words, for this property, just as an example, this property overall would go down in value the first year by $290,909 in year one, or well, actually, assuming once again we put into service beginning of the year, but we're ignoring mid-month convention for the moment. But anyway, and then year two, another $290,909 for year two, and then another $290 909 for year 3, and so forth, so on. It keeps reducing in value by that amount. So that at the end of the 27.5 years, the property is going to be worth only $2 million. That's going to be the residual. But all of the $8 million will be used up at the end of that 27.5 years. So the assumption is that at the end of that 27.5 years, the actual physical bricks and sticks of the building is worth nothing for tax purposes. This is what I'm saying. This is not real world, this is tax world, okay? And that's the distinction that you've got to make with this, okay? Now, the clock on the depreciation restarts if you sell it to somebody. Or die. Yeah, but we'll go with sell it, okay? But the clock restarts if you sell it to somebody. So that if you own the property for, let's say, 10 years, all right? You've written off, 10 years worth of depreciation. You've got 17.5 years remaining on that residential property to write off, all right? So you sell it to, right here to Jeff, and ultimately Jeff gets to start all over with a brand new clock for 27.5 years. But you're saying, wait a second, no improvements have been done over that 10 years. Why is it all of a sudden he gets to start off with a brand new clock? It's because of the tax world, okay? And they simply, in order for simplicity's sake, sometimes they do things for simplicity, sometimes they do things because they're trying to represent reality, but in their minds, the clock starts all over. But the thing is, the price that you sell it to him, theoretically, then would be reflective of the condition that it's in. And then that is what the new value, while the clock starts over, it's also going to be based on, so if you sold it to him, let's say, you sold an overall property to him for, let's say, $15 million, and $2 million was still land, then that means that $13 million would be his depreciable basis in the property whenever he took over ownership of the property. But it can also work the other way around. I mean, so this, in this case, actually went up in value. But, it could have very well been that you sold to him for $5 million, the land is still worth $2 million, and the improvements are worth $3 million. So his basis in that case would be only $3 million for the depreciable portion.
Actually, 2 questions based on what you just said. So the base land value, every single time it changes hands, never gets reevaluated?
Okay. And that's an excellent question, and I only did it this way for simplicity.
Okay.
So I can go ahead and talk about the 3 different ways that you can get to that number. Okay? One way is you have an independent third-party appraisal done at the time of sale. And within that third-party appraisal, and when I say third-party, it's not you, it's not him. If you've hired an actual, independent appraiser to come in and value what the property is worth. Well, in that appraisal, they are going to differentiate, or they should differentiate, between what are the improvements value, what is the land value based upon current market conditions, and actually, show what those 2 different dollar amounts are. All right. Under those conditions, then you can reallocate your model to basically reflect that. Okay. You can't reallocate it during your ownership period, because once the clock starts, it's a fixed allocation. But then when the clock restarts upon a new sale, then they can take that new allocation. So if all of a sudden the land went up in value by $5 million or whatever it is, then he would potentially be able to, take advantage of that. Actually, it's a bad thing because you can depreciate less. Okay, if the other part of the value also, stayed constant. Now, that's one way to get there, is the independent appraiser. The second way is to look up on the tax rolls. Okay, so here you go to the Broward County tax rolls, type in the parcel ID or address or the owner, find out who it is, and on that particular site, it differentiates between here is the land value, here is the improvements value, and that value that they've got may not have anything to do with any other sort of reality other than, that's what they have in the system, but the IRS accepts it as an independent, you know, assessment of what the value is, so you can use that, and you can use not only the value, but you can also use the relationship of the value, so that if they've allocated it as 30% land, 70% improvements, you can just simply apply that percentage allocation to whatever you bought the property for.
That's exactly the ratio we use.
Okay, so you know, so that's yet another way that it can be established. Okay, you can. Okay, go ahead.
Hypothetically, can I own a company that sells it to another company, then get an appraisal?
That's not going to be an arm's length transaction, and so
That's crazy.
there's going to be. Put it this way, if you were to be audited, there's a good chance they're going to see right through that and say, not going to happen. Okay?
What if you own a company and then you...
The whole thing is, let's put it this way. The IRS is the one organization on the planet you don't want to mess with. Okay? And, you know, I have been very fortunate in all my years. I've never had, knock on wood, I've never, you know, had to encounter, and I have always erred on the side of conservatism whenever it comes to the IRS, because I really just don't want to go through the brain damage of going through an audit, okay? I know people who I have worked with who try to find every possible conceivable little nuanced, you know, kind of loophole in the system and try to work it to their advantage. I mean, my best story on that, you know, a real story from several years ago, one of my former professors at Texas Tech in Lubbock was basically had filed his tax returns, and one of the other professors, one of the tax professors, had done his tax return for him. And I mean, it was in a very aggressive, you know, sort of set of deductions that he had taken. And so sure enough, he gets audited, okay? And so the auditor comes in, you know, sits down with the tax professor and my professor, and they, you know, start the dialogue and discussion, you know, arguing over the points. And, you know, this particular IRS agent was like, yeah, you can't do this, you know, this is an unallowable, you know, deduction, blah, 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 blah. And this was just, you just gotta love this. The tax professor said, yeah, we can. I wrote that part of the tax code. Because he was one of the consultants for the IRS that had actually written it. So it was like, yeah, we can do that.
So as long as he does your taxes, then it's...
Yeah, but it was a fascinating, you know, situation. Anyway, all right, moving on. Okay, so with depreciation, we've got our, and let's just go ahead and work through how we got this specific number on the spreadsheet. All right. So if we go up here, and in this case, we know that the land value, I believe, let's see. Okay, so what we're doing, okay, we have the value of the property as 31 million. So we kind of go over here and replace these numbers. I kind of did this on purpose. Okay, so 31 million, 465, 853?
And 98.
Okay, we'll leave out the 98 cents. Okay. Now, what we are told up here, that's our total value of the property. Then what we're told over here is, okay, we're going to first of all decide whether this property is residential or whether it's commercial. If it's residential, we put in 27.5 years. If it's commercial, we put in 39. Okay? Make sense?
Yes.
Okay, so for this particular example, it's going to be commercial, 39 years. Okay? The depreciation, or the based upon the improvements, is it's going to be 80% of the overall value. So what we're saying is that the improvements is going to be 80%. The land value is going to be 20% for the overall value of 100%. Does everybody understand that? Okay, so now what we're going to do is simply take that 31 million.
Those numbers are different because you can have a large amount of land with a little bit of small property. Is that why that?
Yeah, I mean, yet again, this is a regional thing. You know, certain parts of the country, land values are almost nothing. Okay, and the only real value is the bricks and sticks. Whereas here, land values are dramatically higher as a percentage of overall value of the property. Okay.
Yeah.
All right, 31, 465, 853. Oops, 31, 465. Okay, times 80%. So it should give us $25,172,682, and then the difference between those two of 6,000,000. Oh, we need to do this, but I'm just going to sort of throw it up here. 293,171 is our land value. The dollar value that we're concerned with is the improvements value. Okay? Everybody good?
Where did you get the improvement value from again? The
Okay,
25
once again, we're going to take the total value, which is given to you on the spreadsheet, and then you use the 80%, which is given to you on the spreadsheet for the improvements value to get the 25 million, all right? So we go over here, we know this is going to be commercial based upon what we're told here in the spreadsheet. Okay, so we're going to take that 25 million, 172,682, and divide by 39. And we get $645,453 and some change. That would be the annual depreciation amount per year. Okay, now let's look at what we got up here. Voila. Annual depreciation, 645, 453, and some change. Okay, now take a look at how that number was calculated. And you see that all that was done was just kind of what I described. There's nothing more than basically coming over here, getting the value of the property, multiplying that by the 80%, and then dividing by the 39 years. Okay? Everybody good? Okay. Now, just so you know, for those of you that haven't taken real estate investments class, you will have to calculate this in the investments class. So you can learn it now and become comfortable with it, and then hopefully not have to necessarily learn it again, but kind of, you know, recall your memory whenever you get there. Okay. Now, this next one, and there's a couple little funky things that we may need to work out on this, but the month that it's placed into service is, in this case, if we say the month placed into service is 10, what does that mean? October, okay? Now, this is the part that, once again, you kind of have to think about a little bit in terms of how much depreciation you get out of placing it into service in October or any other month. So I'm going to kind of just write this down so that you can kind of begin to gain perspective on this. And for those of you that are just sort of like, oh my God, this is so ridiculously boring and blah, this is where you make your money off of real estate, is understanding this kind of stuff, okay? You know, because this is the sort of stuff that very few people really fully understand. Okay. No, huh, what?
Are we going to go into
No. Okay, so if a property is placed into service each of these months, January, February, March, April, May, June, July, August, September, October, November, December, and we sort of say that, so in January, we said it's going to get a half a month in January, and then the remainder of the year, yes?
Okay, 15.
So you get 11 and a half months worth of depreciation in January. You get 10 and a half months, February, 9 and a half months, March, 8 and a half months, 7 and a half months, 6 and a half, 5 and a half, 4 and a half, 3 and a half, 2 and a half, 1 and a half, and a half a month in December. Okay? Everybody good with that? Okay? Is that a question or was that a
No,
stress?
sir.
All right, so if it's placed in a month, and so the way the spreadsheet is set up, it's when the property was placed into service, which month. So we kind of go back over here just to sort of make sure you understand what it is that's happening. All right, so in the spreadsheet, we're saying it was placed into service in the 10th month of the year, which is October. That means, from a calculation perspective, you're going to get 2.5 months worth of depreciation in that first year. Okay, does that make sense to everybody? Yes or no? Okay, now, let's go over here and go right below that into the cell for the mid-month and see what is done. Okay, so a little bit of logic that gets applied here. All right, so what you're going to do is you're going to take, all right, the annual depreciation number, the $645,000, and then you're going to multiply it by basically, you're going to take, in other words, the formula is going to work like this. You're basically going to say, to sort of get the calculation to be what you want it to be, you're going to sort of start off with 12.5 months, and then you're going to subtract out, in essence, whatever month it was placed into service. So if it was placed into service in month 10, that means you get 2.5 months of depreciation. Does that make sense? Okay. So once again, if you look in the formula that I've got up there on the screen to calculate the mid-month convention, you start out with a fixed value of 12.5, and then all you have to do is then say what month was it placed into service. And then based on what month it was placed into service, that is how many months of depreciation you get. So the calculation, this is out of curiosity, or not curiosity, just out of explanation, if it were to be the 12th month it were placed into service, then all it's going to do is you place that with a 12, meaning you're only going to get a half a month worth of depreciation. Okay, so the purpose of that is just to do the calculation to find out how many months of depreciation do we get. Okay, make sense? Okay, so then after you've done that, then we divide that by 12 to get the percentage of the year that we actually get the depreciation. So in taking the 2.5, you basically say 2.5 now divided by 12 is going to be the percent that you're actually going to be able to take. So 2.5 divided by 12, 0.2083333. Okay, so that's saying that if it's placed in service in October, you get 2.5 months worth of depreciation. That is equivalent to 20.83% of the year. Okay, so in this case, the year amount is that 645. What is it?
453.42.
Okay, 453, good enough. Multiply it by, and you get 134,469 and some change. Okay, does that make sense, everybody? So now, that number should match roughly close. Well, actually, yeah, 134, yeah, it is. 134,469. Okay, are we good? So that will be your number for the depreciation for the first year for the property. Okay, does that make sense? And then that will change automatically if you change the month it was placed into service. Okay. Just gonna scoot on up here just a little bit so maybe some of you toward the back can see. So once again, all we're saying is that cell B30 is just taking that first year, whatever the month it was placed into service, to get the mid-month convention and the amount of depreciation for that particular year. Okay, all good? Okay, and the subsequent years are just simply the full amount for the full year. Okay? All right.
Let's have one question as well. If you're buying it in October, wouldn't?
Yeah,
Okay,
that's
never mind.
yeah, no, I know exactly where you're going, and that's the one that I was just like, okay, I'll leave to another day.
Okay.
All right. So the issue is we fixed one problem, but I created another one, which is then we've got to also then fix out the where the interest payments and the mortgage payments also coincide precisely with that. And for this model, I didn't go into that level of detail. Okay.
No, but also your potential growth income.
Yeah, yeah.
Everything
is predicated on a year.
All right. Well,
Yeah,
I mean,
and we,
spend another.
yeah, and actually, that would be a good assignment for you guys to go in and fix that little glitch. Okay. All right. Yeah, it was really more, I mean, and you're absolutely right, Woody, but the only reason I didn't fix it was really more of just sort of showing how that it worked, because I went back and started to tinker around with some of the other things, and it got pretty distressing pretty quickly of trying to get it to, I mean, it's doable, but yeah, it's a little bit of a challenge. Okay.
So basically, if we were to put it into service in October, it's calculating everything for a year from October.
Well, it's populating it as if it's a calendar year for all of the other things. And so we need to go through and make some adjustments, and I didn't go through and make those adjustments yet. Okay. So pretty much for the rest of the model, you kind of just assume everything is January to December. Okay? All right. Now, so, okay, so the next thing, the next line item is the interest expense. So, with commercial real estate, with investment real estate, one of the tax deductions that you receive, not a tax credit, but a tax deduction that you receive, is to write off your interest expense, okay? You don't get to write off the whole mortgage payment. You only get to write off the interest portion of your mortgage payment, okay? So everybody hear me and understand that, okay? So what we have to do is then to use our good friend, which I think we had used a while back, the cumulative interest payment for the mortgage, okay? And so it's a little bit hairy, but once again, you can kind of click on it and you can go back and see specifically what was pulled down from where and so forth, so on. But all it's really doing is just taking the interest rate, dividing it by 12, you know, taking the number of periods, multiplying by 12, and then saying, okay, well, what is the present value that we're going to start with of the loan amount, and then from there, the starting period, the ending period. So in this case, month 1 to month 12, and this would have been, this is part of where we started to kind of fix the model and sort of say, well, let's max that then up to the month placed into service, but then it got a little bit messy really quick, so we decided to abandon that and kind of back away. But the point being is, this simply is giving us, this is the equivalent of using the calculator and saying, here's our loan information, and then doing one input, 12, shift, amortize, equal, and getting, here is the interest portion for that 12 months. Does that make sense, everybody? Okay? All right.
So if we just wanted to change those periods, we just would start
Yeah.
changing with the 1, we would just put 12,
Yeah, so like,
24,
for example, just look over the next column over. That one has 13 and 24.
Okay.
And then the next one will be 25, 36. The next one will be 37, 48, and so forth, so on, so forth. Okay? Okay. Now, from there, we just simply subtract out those two line items from our net operating income to get our taxable income. But before we talk about that, let's just kind of go back up just for a second. I want to come back to depreciation here just for a second. This set of calculations, these are not, either one of these are not cash expenditures, okay? They are, in essence, embodiments of the tax law and saying, here is the amount that you get to write off for this year. You're not actually getting a check from the IRS, or you're not actually writing a check to anybody for this $134,000 or the $645,000. That's not real money, okay? It's found money in the sense that the IRS is saying, oh, we're going to allow you to deduct that from your income to figure out how much taxable income that you have. Does that make sense? Okay? Now, the interest expense, at least this one, it's part of the payment that you've made on your mortgage, but it's only the interest portion. But yet, when you're paying your mortgage, you're not just paying interest. I mean, unless you have an interest-only mortgage, but you know, for our purposes, that's not the case. But the point being is, those are both deductions that reduce your income to come up with your taxable income. Okay? All right. So once you have your taxable income, then you're able to then simply multiply the taxable income times the tax rate. In this case, we chose 28%. Obviously, those rates potentially change from one year to the next, and I'm not sure what it is, honestly, right now. I'm trying to remember with the latest tax revision if that really changed that much. And then ultimately from there, then that would be your income taxes payable for that year. Okay? Does that make sense? Okay? Now, the part right below this is where, and there's a reason why I've got in both instances an empty line here and an empty line here. Because this piece from 29 to 34, that is a tax subroutine, okay? To figure out, its sole purpose is to figure out taxes payable, okay? So that you can now insert that down here and say, okay, we've got our before tax cash flow, and we're simply pulling it down here, and then from that, we subtract out our taxes payable, which is here, and that gives us our after-tax cash flow, okay? Now, the most common mistake that people make is they come in and they think, oh, okay, well, all I gotta do is, you know, subtract out maybe my taxable income, or, you know, just subtract out the depreciation or something like that. And no, you've got to go through all of this to come up with the taxes payable to be able to subtract from your before tax cash flow to be able to calculate your after tax cash flow. Okay, does that make sense? Okay. And so once again, all of that, just pretty much pulling down the numbers from above, inserting them, and doing the subtraction. Okay. All right. Now, let's sort of moving across the page. Really nothing is, I mean, all of these are just simply going to be based upon the numbers above, so there's nothing really new to any of these. It's just pretty much just carrying down the page. Now, if you were to have different tax rates as you go across, then obviously you know, potentially change those, so forth, so on. Okay. So let's move on down to these return sort of calculations, okay? Any questions at this point? Max?
So I just got done dealing with a lot of tax stuff, like for my personal taxes, and so one of the things that they mentioned to me was how I needed to start doing quarterly tax payments because I'm 1099. How does that fall into place with something like this?
Okay. Quarterly tax payments are simply meant to provide an estimate for what you owe on a quarterly basis to the IRS. Because if you're self-employed and you're pretty much only getting your income through 1099s, or in terms of dispersions from title company or broker or whoever it might be, the IRS does not just simply allow you to wait until the end of the tax year to make all of your income tax payments. I mean, you theoretically could wait until the end of the year to do so, but then they would basically tell you what they just told you, which is, we want your money sooner, okay? We want you to be making, these tax payments to us on a regular, consistent basis, so that we're getting the money sort of as you earn it, as opposed to all in one big lump sum at the end of the year.
Is that something they, is that something they expect you to do with this type of stuff?
Well, with this, you're going to be probably doing most of these operationally on a month-by-month basis. This is kind of summarizing everything on an annual basis, but in most instances, you're still going to be doing it on a month-by-month basis and seeing what those cash flows are. And yes, there's a very good chance that you would want to go ahead and potentially make quarterly tax payments so that you don't end up in a situation of where you have this big, huge, massive lump sum at the end of the year that you've got to actually fork over. Okay. All right. Yeah. Okay. So the first one, in terms of a return calculation, this is what we refer to as return on asset, which is, in essence, it really is your cap rate for all intents and purposes. But it's also called, in this particular circumstance, the return on asset, which is simply your net operating income divided by the value. So if we look at this, you're simply going to take that $2,046,300, and you're going to divide that by the overall value of the property that we found up at the beginning, which was like, what, 30-something million? Yes, sir. Well, on the sheet here. You're going to take that 31,465,853 as your value. So you're going to take the net operating income divided by that, and in this case, it gives you 6.5%, which is in essence the equivalent of a cap rate. Okay, we're calling it here return on asset, just the same thing, but it's kind of in just a different term. Okay, now as you sort of move across the page, what you're going to see is as your net operating income goes up, then that return on asset is also going up. Okay, so just kind of pointing that out. Okay, nothing first set right there. Now, the other thing to sort of point out about that return on asset, okay, this gets back to one of Brian's comments from earlier about another sort of problem. That return on asset is an unleveraged rate of return, okay, because it's based on the net operating income. So that 6% is an unleveraged rate of return. We haven't quite talked about financial leverage yet. We're going to, but right now that is an unleveraged sort of rate of return, strictly based upon the net operating income and the value of the property. Now, right below it is a before-tax return on equity. And so, in this case, we have our before-tax cash flow of the $472,000, that we're taking that number and we're dividing it into the few $1 million, whatever it was that we had. Pull up the sheet here. Actually, we calculated it earlier. What have I had? Oh, there it is. Yeah, $7 million. So we're taking the $472,000 and we're dividing that by the $7.866 million of equity that we have invested in the property. So this is just simply telling us this is our rate of return based upon the equity that we have contributed to the property. Now, in this case, that return is less than our return on asset. And so what it's basically saying is that we're really not getting any leverage effect from the property for that first year, probably because we're not getting the full amount of the depreciation, so it's not juicing the return at all. Whereas you can see in the subsequent years that that return only increases as we sort of go across the page, and it substantially gets higher and higher as we get deeper and deeper into the property. Okay? And the last one that we've got there, the after-tax rate return on equity, is simply taking our after-tax cash flow and dividing that by our equity. Now here's the thing. Most investments that you are going to make comparisons between from one person to another person, you are going to do on a before-tax basis. And the reason you're going to do that is because everybody has a slightly different or very different tax structure, okay? That, for example, you have somebody that maybe is a retiree. They have no income other than what they receive through Social Security and that sort of thing, and so they have no earned income, and so them getting paid a return off of a real estate property is going to be treated differently at a different tax rate than someone that is, let's say, an active earner and what their tax rate is going to be. Does that make sense? I mean, those are just a couple of examples, but you're also going to have different tax rates for corporations, different tax rates for different types of ownership vehicles that are going to apply. Now here's, the thing that you want to try to I guess, put into perspective. There's an awful lot of details as it relates to this tax stuff. So much so that it's easy to get really mired in the weeds on this stuff. But let me be very clear. This is also, as I said earlier, where you have an opportunity in many cases to really scrape up a lot of extra cash that you can put in your back pocket by understanding it, okay, and understanding it reasonably well. You don't have to become a tax expert, but understanding it reasonably well. But another little just sort of statement that I will make, this university, like many other universities across the country, and I'm not trying to say that, I'm sort of saying it to be funny, but I'm not saying it to be funny, have entire degree programs just for taxation. Okay? You can go and get a Master of Taxation degree that is almost exclusively dedicated to just understanding the federal income tax code and and all the different components of it, whether it's to deal with real estate, whether it's to deal with trust, whether it's to deal with, once again, business operations, whatever it might be. The part that and the only reason I'm sort of bringing this up, but I think this speaks to, we have made some things so complex that you have to have professionals to intervene because the calculations are so convoluted and detailed that, it begins to sort of make your head want to explode, okay? And we only scratch the surface with this sort of stuff, okay? But, and so I just want you to kind of put that into perspective when you're sort of thinking about, oh my God, this is all tedious and so whatever, but yet there is a payoff in the sense that if you have a fundamental understanding of it, then at least you know some of the right questions to begin to ask whenever you're actually engaged in a deal and kind of can ask your tax accountant, well, what about this? Should I be able to depreciate this and a little bit quicker if I do it this way or that way? Yeah.
So, from like a career perspective, I didn't know this was an option of real estate tax advisors, and then I met a bunch of people with First Point, and that's because in their claim to fame is why they're always needed. It's the second, or it's like the largest line item of the year, and to be able to minimize that, outflow, do you find that that's true in a lot of places?
Oh, absolutely.
And it's the biggest line item of the year, and that's, yeah.
Well, just look at me, like, this once again is just an example, but look, if you can, minimize, you're talking about $100,000, plus dollars a year off of this property, but imagine that if you're able to reduce that tax bill, like 10,000 here, another 10,000 there, that begins to pay for that service, pretty quickly.
Yeah,
and there's so many mistakes and miscalculations and everything that you can do on your own that, these guys hopefully are trained to be able to spot instantly and fix. So,
yeah.
Anyway, not to belabor that, but I think it's important just to kind of have that perspective, okay? Okay, moving on down. All right, so what I've done here is to kind of show the cash flow structure off of this deal and what's sort of taking place if you make the assumption of it being an all-cash deal and only using the net operating income as your income that you're going to use. And then that would assume that it's an all equity, all cash deal, so you pay the entire purchase price and what those cash flows would be. And then the reversion, once again, that's going to be based off of the year 6 NOI using the cap rate down here of the 6.5%. And then you're going to add that to your final cash flow. And then once you've done so, then you're able, just like we've done with the calculator, go through, put in these cash flows, and then you should be able to solve for your internal rate of return for the deal, and you'd find 9.44% for internal rate of return. Okay? Does that make sense? Okay? Now, the deal that's actually here is not obviously an all equity deal. It is, you know, a blend of equity and debt. And so, looking at it in terms of the amount of equity that you put into the deal, then you're going to use this column and sort of say, okay, my before tax cash flows are the cash flow streams I'm going to use here, but the initial cash outlay is going to be your equity that you're putting into the deal. So that number, once again, given to you there on the sheet, $7,866,000. And then for your reversion, here you're simply going to take what do you sell it for, subtract out, in essence, your mortgage payment or your mortgage balance, and then add it to your final year cash flow, and then get that. Okay? Okay, we're going to stop there because the after-tax cash flow gets a little bit trickier. Okay? It's very straightforward in the sense that you have the same cash outflow from an after-tax perspective, and you've obviously been able to calculate your after-tax cash flows for each of the years across the page, but the part that gets tricky is this reversion piece, which we do down below. There's another sort of little subroutine. Yeah. So we scoop down here. Okay. Now, you can see this on the handout. It's on basically the back side of the handout in the big box in the kind of bottom right-hand corner. Okay? That box, just to kind of put things into perspective, is for the sole purpose of calculating what is going to be my reversion value from an after-tax perspective. Okay? Does everybody follow that? Okay? So there are going to be a few things in there that are going to seem familiar, and then other things you're going to be like, what the heck are they talking about? Okay, so let's talk about some of those things. All right, so we're going to take a look at the box here. Okay, so the first thing that we've got is what we call the basis of the property at acquisition. And for this is, from the tax perspective, this is the total purchase price of the property, okay? And then from that, we subtract out depreciation that we have taken, which is simply going to be adding up all 5 years of the annual depreciation numbers. Okay, if you were to add all of those up for all 5 years, what you should get is this 2.7 million. Okay, does that make sense? Now, what you're doing is you're saying, okay, we bought the property for $31 million, which is the total value of the property. But from that total value, we subtract out 2.7 million, which is the accumulated depreciation we've taken over that 5-year holding period. Okay? Then what we're left over with is what we call our adjusted basis at sale. Now, this is strictly a tax calculation. Means nothing outside the world of taxation. All right? So we just do that as one little subroutine. Okay? Then we do another little subroutine. And this one is to calculate what we call our capital gain. Okay? In other words, the simple before you look at this, let's just make sure that you understand the simple concept of a capital gain. Capital gain, I buy it for this, I sell it for this, the difference between the two is my capital gain, okay, in very simplistic terms. But with income tax considerations, there are adjustments that have to be made to that number, okay? And that's where this little subroutine comes into play, all right? So we start off with, okay, what do we sell it for here at the end of year 5, all right, which is based on, once again, the cap rate of 6.5% on the NOI for year 6 to give us the 36 million, okay? Then we subtract out this adjusted basis at sale because the IRS is saying that's the number right now that we value the property at, okay? So you subtract that out from what you're selling it for. That gives you what the IRS is going to refer to as either your gain or your loss. In this case, you get a $7.6 million gain, okay? But unfortunately, that's not the end of the story for them, okay? All right? Because you have a gain, then what that means is you've got to then adjust that gain by the cost recovery or the depreciation that you've taken to ultimately get the capital gain that you are receiving from the property, okay? In this case, the 4.8 million, okay?
Is it like accounting for it twice? Because,
Yep.
okay.
All right. Then we come down, we have the sale price, another little subroutine. We subtract out the mortgage balance, we get our sales proceeds before tax. Then we have the tax on the cost recovery recapture. Now this is where it gets kooky, okay? Basically what they're saying is, because you sold the property for more than what, in essence, you paid for it, and you've taken depreciation on it, what we're going to do is all that depreciation you took, we're going to tax it, okay? And we're going to tax it at a 25% rate. Yeah.
Is there a way that you can sell a property for the same amount and then charge some sort of fee so that it's not?
You're going to be thrown in jail one day.
You should buy a Leah, man.
You know, seriously, those are precisely the sorts of things that are going to get you in trouble. You know? So be careful, Chris. Okay,
Be
that's all I'm
creative.
saying.
Creative accounting.
Yeah.
Creative accounting.
That's the thing.
But no, but seriously, you've got to be really careful because they're going to look, especially at larger deals, they are going to look at the paper trail as to who's involved, what's involved, and what kind of maneuvering that you potentially did to try to minimize your tax bill. There's nothing wrong with trying to minimize your tax bill, you know, and tax, in essence, avoidance is one thing, but, you know, tax evasion is a totally different sort of thing.
Where's the line?
No, that's why I'm asking this, because
No,
I
no,
don't want to
but-
do anything that's...
But that's what I'm saying, that's the sort of stuff that you've got to get professional sort of advice on as to, you know, how far can you push that, okay? Because, yeah, you can sort of say, okay, you know, at the end of the day, all I'm doing is filing some paperwork with the IRS and filing my tax return, you know, who's ever gonna look at this, who's ever gonna pay attention to this, and that sort of thing, and then all of a sudden you get a knock at your door, you know, and a bunch of agents are lined up ready to take you off to jail, you know, so just be careful.
No, I'm just
Okay.
clarifying to make sure that if there are ways, then there are legal.
Yeah, there are a lot of legal ways to avoid paying more tax than you should pay, okay? But just be careful. That's exactly what tax. All right, so moving on. Okay, so the next one, so as I said, you get taxed on the cost recovery recapture at 25% tax rate, and then you have a tax on the capital gain. So the fact that you sold it for more than you did, then ultimately you got to get taxed on that as well at a 20% rate. So what you have happening in a lot of instances, and this is where people start playing, if you've taken notice to this, you have 3 different tax rates that we've introduced into this. A 28% tax on ordinary income, a 25% tax on recaptured depreciation, and a 20% tax on capital gain. Now, most of us, we're just sort of just thinking very logically, if we could sell a property and only had to pay capital gains, we would prefer that. And so any sort of strategy that we might employ that would help us to only have to pay capital gains tax, we would probably want to do. Well, how can you do that? How can you avoid basically the 28% ordinary income tax? You have the property lose money each and every year, okay, in terms of the ordinary income, all right, by virtue of putting more money into the property, having expenses, you know, affiliated with the property, in essence, going in and reducing your ordinary income, and then maximizing on the back end would be the capital gain, okay? Yep.
That's what everybody does, but I have a question for you on the flip side of it. Whenever you're evaluating, so say that's how you build it out, but when you go to sell it, right, and you're looking for evaluation on the performance of the property, it's just one of those unspoken things that you know, these and those line items are subject to the individual.
So basically you have two balance sheets you're making?
I wouldn't go quite that far. No, I wouldn't. I mean, I would just simply say that it's just your motivations for doing what you do are for tax reasons.
Right.
Okay? It's not that the cash in, cash out is going to be any different. It's just like, let me give you a perfect example, okay? One of the most common. When you're dealing with something like a roof replacement on a property, okay, this is probably the most classic example of all, and Chris remembers it from, the investments course. If you repair the roof, in the sense you're fixing holes, whatever, in the roof, that's considered a repair and maintenance expense, which is an immediate tax deductible expense, okay? But, and you get the tax benefit in that year at the 28% rate, and it's a nice benefit for you. But if you replace the whole roof, that's considered a capital expenditure, which then gets classified as not an expense in that year. It is going to be potentially something you're going to have to depreciate over so many years in terms of the tax benefit that you receive. So what you have happen, and I have seen it multiple times, is you have people playing the system, and they sort of say, okay, if one end of the extreme is fixing a hole in the roof, and the other end of the extreme is replacing the whole roof, then somewhere in the middle is the breaking point as to whether or not we can classify it as a repair and maintenance or classify it as a capital expenditure. And so I remember several years ago when I was living in Austin, Texas, we had one of the property owners for this bigger property, they literally were replacing half of the roof. And, and you were just like, why are they replacing half of the roof? Why are they not doing the other half of the roof? It's just as bad as this half. And you're standing there, you're sort of scratching your head, you're trying to figure it out. And I actually went in to the property manager at the time, and I said, what are they doing? And he said, well, the owner realizes that he can get he can basically write off the whole expense of replacing half of the roof today, and then ultimately next year, write off the other half as an expense, as opposed to only being able to write off a very small piece of it, for that year. So people constantly are doing stuff like that, and it's legal, but it's questionable, but it's legal, as to, how you potentially allocate. And this is the part that sort of makes your mind, sort of explode over this, but there are people's jobs who their whole job responsibility is to look at the properties that are being managed and saying, what things might we be able to expense so we get the maximum tax benefit this year versus deferring that off into future years, okay? Yeah.
Well, that crushes your NOI, so you're not selling.
Right.
Okay.
And that's part of the point, that there are all these different motivations, you know, and once you kind of understand that the tax law influences behavior, okay, then, you know, it's amazing to watch how people react to that, okay? I mean, another weird one, I mean, if you just want to talk about weird sort of tax laws, you know, and they've modified it quite a bit over the past few years, but you used to have this once in a lifetime, you know, sort of deduction for your personal residence and your limited lifetime kind of deal of, I forget now even what the dollar amount was so many years ago, but I want to say it was like, you know, limited like $250,000 per person or something like that of a capital gain on your personal residence, and this was for many years, and they changed the law since then. But the way the law was written was, basically, if you were a married couple, you only got one sort of exemption, and so there was this perverse incentive to basically get divorced to take advantage of the tax law to get that, to save on the capital gain. And so you honestly had people divorcing in order to take advantage of this really quirky sort of, you know, tax law. I mean, it's just, it's mind-blowing, but my point is that people constantly, you know, to deal with these sort of tax implications. Okay, all right, moving on. We're almost done with this, and we'll move on. Okay, I think that's, let me just see here, does that get us through? All right, I think we're through with that, so let's go ahead and take a little quiz. Okay, take a 5-minute break. I know you're all kind of stressed out, so.
You don't have any depreciation, and when it was 15%, it was like having, you made $1 million, you didn't have to pay a lot of tax. And even then, these guys, they would sit around and trying to figure out, if you're only paying 15%, why wouldn't you pay the taxes? Why did you 1031? That's how greedy this is. That's how greedy you are. My dad said, God bless him, he said, paying the taxes is always a good thing. I mean, you here?
GIS or this session?
No, 6, we bought like a 15 million. He did a 1031, we made $30 million. He lost his money. So I'm thinking, why? He still has plenty of money, but he would have been, after that one deal, and we sold it to Terry, which they're gone now. They were nice. We paid like 8 big, they paid $40 million for they were gonna $40 million. The day that we closed, oh my God, it didn't have even, it turned into that 1031. It was 4 Saturdays. That's a whole career for people.
Oh, man.
I go in their office all the time. Hours. So that is a huge part of it. Because once you make one,
Then you get to absorb more.
when you're done,
It sounded minimal. I looked into it. Gosh, Jesus, scared me.
somebody's
My
off.
shoelace hit my back, my calf.
So this is gonna be an LLC, right? Oh, yeah, they didn't know tax benefits, which her income would go to.
Dude, they do.
Has like 50 views or something.
What, 60 views? They could learn it the first time? Slow?
She pays more than I make a year in taxes. It kills her.
This is like one of those like
Is it
police
fair?
body
No.
cameras. It's like you got a lot of
That's why you look at demographics of Broward County, and the ATM income is so low, but nobody claims anything. Everybody's under the table. And is it a real true barometer of Broward County? Probably not.
Nope.
I love this model. This is the one that I didn't do that well in the finance. I was a rookie. And what screws you up is this reversion at the end here, because you really got to calculate all this down here. And when I did my test, I think it was our final or whatever.
Like a private consultation, consulting company?
That's why there's that. This looks like the same model we used the other.
Okay.
But you really got to break that down to a 2-month period. So it's, I guess you can just divide by,
Yeah,
or multiply by a factor, and
yeah.
bring it down to some common,
Okay.
or start at year, start at the beginning of the year.
Yeah. Well, it's really what I always did, and I thought, oh, I'm gonna be fancy, I'm gonna.
So they're trying to figure out
Then you
which
gotta
piece
keep
of
it
technology they should be starting to get into.
Your mid-month.
It's good, man. Piece of building.
I guess next.
3 more weeks.
Got one.
And I'm out. I gotta tell you, it's kind of scary with home builders. Because it's all regional. It's the ordinance wasn't, because their margins are getting slow, because they were already 25% 3 weeks ago.
Well, it's pretty easy to see. I mean, just a person driving down the street, I was being put up for sale because people were getting scared they're gonna be upside down quickly with the person.
Oh, I don't think it's gonna go down, I still think it's gonna continue. Because, you know, once the affordability hits a certain point.
exciting story.
That's why Trump was saying, that's enough to the Federal Reserve. The president usually won't be involved in that stuff.
Okie dokie, listen to this little quiz.